It has been a week. Sunday, August 11, 2024. My name is Michael Guide. Welcome to another edition of Morning View. These clips I put out with things that are on my mind. I apologize. I've been beyond overwhelmed and honestly humbled by the amount of attention I've gotten the last week and a half or so. Usually I put these clips out as often as I can, but I really haven't had time to do so. The last Morning View video that I put out there now on X alone had over 1 million views, as the reverse carry trade that I've been talking about since August of last year seemingly started, and everyone became an expert on it. For today, I want to do a real big deep dive on the whole thesis to begin with, why I'm calling what's coming next the main event, and how to think through current intermarket dynamics from a lot of different perspectives. Now, I'm not a perma bear. I'm a guy that has skin in the game. I have been early and wrong in this argument around the credit event, the main event, but nothing really changed, which is why I stayed true to the idea throughout all this, despite people misunderstanding what it is I was trying to highlight, with Japan in particular being the spark. Now, I'm going to show you a series of posts here, which I think are fun to kind of go through for some context with timeline. August 4th, Sunday, I put out this post on X. It said 2 days ago, which would have been Friday of the prior week, prior to that Monday, Black Monday move. I said 2 days ago, I thought I broke my prior record in terms of daily impressions on X. I didn't. The prior peak in terms of my reach on X was end of October of 2023, when I was peak bearish and wrong entering November, obviously, in the single roll of the die. This reach now is due to everyone now focusing on the reverse carry trade. Suddenly, everyone started saying maybe this guy, Guyed, was right all along on the idea. But I floated this out there. So what if this is a contrarian signal? The fact that everybody, their brother, their mother, their pet hamsters, the basement squiggle boys, they're all talking about this reverse carry trade. Maybe that's actually a contrarian signal, which I think is interesting, because maybe with hindsight, I should have thought that way back in October of last year. See, I can learn, folks, from my own mistakes in terms of how I'm viewing things. But I saw this, I was blown away by the whole dynamic. And then little did I know how much crazier it would then get. So if you're going to accuse me of being a perma bear, you better reevaluate that thinking, because clearly I'm not. Then comes Monday. And I thought that reach on impressions was incredible. I mean, it was almost as high as it was in October of 2023 when I was as negative as I was. I started getting tremendous follows out of nowhere. Something like 20,000 new followers in a span of 48 hours on X. Started getting hundreds of emails and direct messages from people saying, you were right all along. And then this happened, which is really nuts to me. That Monday where the VIX printed, perhaps erroneously, 65 pre-open. This is my impressions on X over a full year. On Monday, August 5th, I got 14.2 million impressions in a single day on my posts. Kind of looks like the VIX, okay? But I looked at that and I said to myself, I don't know. Everyone's talking about the reverse carry trade. Suddenly everyone's an expert on it. I'm getting all these follows. I'm getting all these high fives. I'm getting all these impressions. I think to myself, you know what? Can't be that easy. The market does what it does to screw most people. That's why at the start of the week, my tone very aggressively changed, just as it looked like things were about to break down heavy. The contrarian in me came out. I put this out on August 5th, Monday, at 7:41 a.m., even before the market opened. I said, these are the VIX levels where the brave profit. The end of the world is the bull case. By the way, you may have noticed that now one of the things I try to say when I communicate is the real ones know. The real ones who know me and track me. The real ones who know that the persona that you saw the last 2 years was an act, because it worked on the X algorithm to get reach. The real ones who know me know the research, the lead lag report. The real ones who know me have seen me present across the country at CFA chapters multiple times over. The ones who know me are the ones who've actually read my award-winning research papers, which I am damn proud of. 2 that won the Dow Award, 3 that won the Founders Award. The real ones who know me know that I have skin in the game. That I'm not a portfolio manager, I'm a product developer. That needs a very specific cycle of risk on, risk off for my own strategies to stand out. Why else do you think I say there's no gurus, only cycles? The end of the world is the bull case. I said that Monday when everyone's suddenly freaking out. The real ones know. The last time I said that adamantly was October 2nd of 2022. 2 weeks before the bottom. I got a DM from somebody saying, what would turn you bullish? And my response was, the end of the world. It's when everybody's bearish, which is what happened Monday. Now, I promise you I'm going to get into the main event thesis. I put this out also on that Monday. Everyone will get fucked in this. The Bulls and the Bears, you were about to be whipsawed. As everyone was getting bearish, I was actually saying the exact opposite with everyone high-fiving me around the event, seemingly taking place with the reverse carry trade, which I'm not going to rehash what that is because I think apparently everyone's an expert now on this. I was observing as the market was open that treasuries were weakening into the hemorrhage for stocks. Again, I said you were about to be whipsawed. By the way, I am blown away how many people don't seem to understand the definition of the term whipsaw. By the end of the week, people were like, where's your whipsaw? And I'm like, what are you talking about? Look up the meaning of words before you respond. Then I put this post out, and I see people saying, oh, you're moving the goalpost. And again, they're not even understanding that this was my thesis all along. Japan was the spark to the main event. I said the risk is no longer Japan. It's like, here's the birdie. Here's the Mothra. The risk is credit. It always was credit. The main event is the credit side of things. And of course, then I put, few understand this. By the way, the whole few understand this, exquisite, atrocious, using the few word and the other F word, these are all meant to game the algorithm. Like it or not, it works. But do not discount my analysis. I've been at this business a long time. You want to trust JP Morgan that says 75% of the carry trade is done? Be my guest. Good luck with that. I will stay true to my beliefs which have not wavered despite all the attacks and all the insults, because nothing changed except narrative following price. And I'd argue the wrong price. So markets rebounded fairly well, right, this week. Looked like the end of the world Monday, the bull case. Everyone and their brother and their mother and their pet hamsters is suddenly talking about the reverse carry trade. And Japan basically essentially says and admits that they screwed up. And, well, we're not going to raise rates into market turmoil. And everyone's like, oh, great, that's it. It's over. Reverse carry trade is over. First of all, you don't undo the reverse carry trade, which is something that's been ongoing for years in the span of 48 hours. Like, this is outright insanity that people think like this. Why do you think I kept on showing the Mothra? Because in a chaotic system, a butterfly flapping its wings creates a hurricane. In a complex system, that's what happens. Especially one that's highly levered. Mothra is the butterfly. Okay, in the analogy. You really think Japan is done with this? Are you serious? Just because they said we're not going to raise rates into volatility? Have you looked at the inflation rate in Japan? Have you looked at oil priced in yen? Nothing's changed here, folks. I'm honest to God disturbed by how quickly people change their mind on things. And how suddenly the attention span just seemingly gets shorter and shorter. We went from soft landing to the Fed's got to cut rates by 75 basis points and do an emergency meeting. Are you out of your damn mind? Is this really how the crowd thinks? Nothing's changed with Japan at all. Now, I want to show you something because I think this is really interesting as I started going through it. I often say it's all the same trade. It's all the same trade. Okay. Let's look at the yen. So here's an ETF, FXY. The yen bottomed entering the first week of July. You can see it here. I circled it. Okay. Yen then rallies. There's your spike and the panic. And then you see the red candle, obviously, which is last week. By the way, it still looks like an uptrend. Just early. Okay. Now watch this. It's all the same trade. It's all the same trade. Watch this. Look at, this is the ratio of small caps to large caps. The Russell 2000 ETF IWM divided by the S&P 500. When did that ratio bottom? Where small caps stopped underperforming the S&P 500. Entering the first week of July. Just like the yen. What, we forgot that historic blowout of small caps relative to large caps, how suddenly small caps are running and everyone's like, this is the rotation. That's it. This is going to drive us higher. No, it was a deleveraging setup. Yen bottoms first week of July. Small cap, large cap ratio bottoms first week of July. Here's the Russell 1000 value, IWD, divided by the Russell 1000 growth, IWF, which is basically value versus tech, because the big differentiator between the value style and the growth style is one sector, and that's the tech sector. When did that bottom? Value started outperforming after the first week of July. How about bonds relative to stocks? Here's the AGG, Aggregate Bond ETF, divided by the S&P 500. When did bonds start outperforming stocks? First week of July. Don't you see, folks? Don't you see that it's all one trade? It's all the same behavior. And I've been stressing this for the longest time. I don't know how to make it more clear. Here's the NASDAQ versus the yen. It's not a perfect inverse correlation. It's pretty damn close. The irony of all this is that with all of my NVIDIA's effed posts, where I was dead wrong given the performance of NVIDIA, although I said repeatedly, don't short, it doesn't work. The irony is that I was wrong because of the carry trade persisting longer than I thought it would. That's why I put this post out. It was never about NVIDIA. It was never about AI. It was about the carry trade. It was about the yen. It is, was, and always will be about leverage. And by the way, the precursor to every main event in markets, the precursor to every tail event, the precursor to everything is overconfidence, which leads to leverage. And Japan has been the enabler of that leverage through the carry trade. But that's not the core of the thesis for me. Japan was the spark. The problem can best be summarized, and this all goes back to why I have kept on saying small caps hold the key. The problem is small caps relative to junk debt. This looks at high yield junk relative to investment grade bonds. That's in the dark blue, and then the light blue is the Russell 2000 small caps divided by large caps. Small caps are the junk debt equivalent of the equity market. Junk debt is the small cap equivalent of the bond market. They should behave similarly in terms of factor movement, meaning if small caps are underperforming substantially, if they're going sideways and don't make new highs like we've been seeing for the last year and 3-4 months, then probably junk debt shouldn't be doing that well either. Why? Because what's the reason that small caps are underperforming? Because of the headwind of higher for longer rates, because of the headwind of refinancing risk. Zombie companies. Many of these companies likely will not make it unless the Fed gets it just right in terms of lowering just as the refinancing wall hits. Yet, you look at junk debt credit spreads, they have kept on narrowing and narrowing and narrowing, what I called hell. Because in my world, risk off is default risk off. Small caps have gone largely nowhere because there's concern about them being ongoing businesses. There's concern around default risk by the small cap equity side. There has been no concern about default risk in the junk side. That is the disconnect. And by the way, you can say, yeah, sure, but this was diverging all the way back in 2016. Sure, but not directionally like this, where spreads kept on narrowing and small caps kept on getting destroyed relative to everything else, where most stocks are still trading below their 2021 highs. This has been the core issue for me. That is the divergence, which is what has resulted in people branding me as some perma bear. No, it's that nothing changed, folks. And I feel like I've been very clear on this, but it's just not resonating. And I until it's too late, until finally it happens, just like something the reverse carry trade resonated out of nowhere. Again, I'm not a perma bear. If small caps were to run like hell, then you know what? The junk debt side is right. Credit spreads were right all along. There is no default risk. And the opportunity is small caps. That seems to be unlikely given the way unemployment is rising and given what looks to be now finally a recession really coming just as everybody was giving up on the idea. Like, really, folks? You can't make this up. It's almost too perfect in terms of the way the market throws everybody off. This is the main event that Japan, I believe, has sparked. Okay? I've shown this before. I'm going to keep showing this until it clicks. The blue here is the VIX index volatility. The red is credit spreads, the differential between essentially junk and AAA. It's a way of measuring default risk, the bond market's perception of bankruptcy risk by companies. Do you notice something here? They correlate. Do you notice the far right here? The divergence? I'm not trying to be alarmist. I'm not trying to be a doomer or perma bear and try to grab attention for the sake of grabbing attention. No, I look at this and I get disturbed because to me, this is how you have an implosion in the junk debt space. It's the resync. The resync to volatility, to that historical correlation of junk to the VIX. Now, maybe the VIX comes down and all this ends up going away. I just don't think that's likely. From an intermarket analysis perspective, you have to respect divergences. This is a hell of a divergence. So we have divergence in terms of small caps relative to large caps, and then credit spread. Then you have a divergence right now of credit spreads against the VIX. And everyone looked at that VIX spike on Monday and perhaps started saying, well, that may have been it. It came and went. No. I think we're very early on this. And I've said it repeatedly. I was on David Lynn's show. I said, I think this is going to be extraordinarily tricky. The main event is the credit event. And by the way, I put this out there to make it even more obvious. I reposted this from Barchart. High yield bonds see weekly outflows of $2.7 billion, the largest outflow since October 2023. You know, October 2023, when I was bearish for the right reasons, but wrong in outcome. I don't think I'm going to be wrong this time. Maybe I will be. Maybe the market's going to rip right back up. Maybe I'm totally wrong and the whole reverse carry trade was a nothing burger. But what if I'm right? What if the asymmetric risk is that tail event? Which, by the way, would be a hell of an opportunity to buy into afterwards. Because I think high yield can be yielding 20, 25, 30%. Some bonds will be trading incredibly cheap on the dollar. And those would be great buys. People forget that from a risk on, risk off perspective, I need risk off back to risk on. That's why I can't be a perma bear. I don't know why people seemingly vilify those that have an opinion different from theirs when it's grounded on something that is very real. Now, I think this is a good visualization of where we are and why I'm saying I think this is early. This is high yield junk debt, that ETF HYG divided by AGG. This is like a crude way of telling what credit spreads are doing. If the ratio is rising, that means high yields outperforming AGG, AAA, obviously not exactly the same duration, but still fairly close. Falling, which is basically spread narrowing. If the ratio turns, that's widening. We are so early on this, folks. This is where we are. So people will look at that move intra-week and say, well, we're going to come right back. And you know what? We might. Again, I don't know for sure. I'm the first one to say there's no gurus, only cycles. Yeah, I got the thinking correct in terms of the reverse carry trade, but as I keep also saying, path matters more than prediction. How you get to the endpoint is what matters. And that's the big question mark. I don't know the mile marker. I might crash my car. I know the conditions that favor the accident. So you have this big green turnaround here. Like in 2020, you had a similar green turnaround in junk debt. My point is we don't know just yet. But I look at this, I say to myself, this is broken. Spreads are very much due to widen. Very much due to widen. Logically. By the way, I do think there's going to be some real liquidity concerns in the high yield junk space, especially around private credit. I put that post out saying private credit is this cycle subprime. Because it's not mark to market. There's a hell of a lot of money chasing it, and probably a hell of a lot more risk than people realize. So we'll see. I think if something's going to happen, I think it's towards the end of the month into September. For those that say, where's your time frame? I'm giving you a time frame as far as where I think the risk is highest. It's also around the time when all my signals likely line up. And typically in advance of major tail events, crashes, corrections, bear markets, utilities are strong in advance relative to the market. Treasuries are strong in advance relative to the market. And lumber relative to gold is weak. So I keep saying, keep watching gold because I think that's going to do the heavy lifting now on that relationship. You don't short into it. Doesn't work because you're going to get whipsawed. Like I said this week. Just be mindful here of scenario analysis. Final thing I'll leave you with. Put this AI generated image. The stock market this week explained. The real ones know. Look, folks, I really do try my best to be open and engage, have that integrity out there in the thinking and the research. I will be very loud when I believe that this is over, and I will be saying melt up, and people will be then saying I'm a permabull. I lived through this enough times. Like everyone else, I need a particular cycle for my approach to work. A cycle which is pure risk on, pure large caps. Does not work in my world because you get whipsawed to death because you don't have the tailwind around volatility. And you don't have the tailwind around small caps, emerging markets as ways of generating alpha from a rotational perspective. I've gone on record saying I believe that this AI mania will mark the blow off top for U.S. large cap dominance. I believe, as I showed you with this all being the same trade, that is going to prove out to be very accurate with hindsight. I think we are in a cycle shift. I do think value is going to likely continue to outperform growth here. I do think tech is finished on a relative basis. And I do think that we're probably in an age of turbulence to some extent. Again, you don't go through the fastest rate hike cycle in history smoothly. So all these talking heads that are referencing data that has no predictive power at all, seemingly they all forgot that there are lags to everything. So like I said, you want to believe that it's over? You want to believe that JP Morgan is right about 75% of the carry trade being done? You want to believe that we're going to go straight up into the moon? Keep believing. Doesn't matter to me. I know my analysis. I know my reasoning. I know I can be wrong in this single roll of the die. But you know what? I will not relent. Thanks for watching.